Greetings, and welcome back to the podcast. This episode, we are joined by Mr. Dave Burton, CEO of Lycos Energy, a TSX-listed energy company with a market cap of approximately $200 million. Mr. Burton has more than 27 years of experience in the upstream oil and gas industry in all areas of petroleum engineering work. Prior to founding Lycos Energy, Mr. Burton was a co-founder at Raging River Exploration and Wildstream Exploration. Mr. Burton is a professional engineer and a member of the Alberta Association of Professional Engineers and Geoscientists of Alberta. Mr. Burton also holds degrees in petroleum engineering from the University of Alberta and a Master of Engineering degree in Chemical and Petroleum Engineering from the University of Calgary. Among other things, we discussed a few lessons and stories from the Remington energy days, fishbone wells, and why horizontal drilling is evolving. Enjoy. This podcast episode is sponsored by Enverus. Enverus is the world's largest energy-dedicated software-as-a-service company committed to helping customers close the gap between data and value creation. Enverus has been supporting the Canadian energy industry for over 30 years. Visit Enverus.com for more details. This podcast is sponsored by 5 Quarters Investor Relations. 5 Quarters elevates financial communications and market engagement strategies with tailored solutions designed to drive substantial value. With cross-sector experience and a focus on trust, quality, and integrity, 5Q can enhance your company's investor and stakeholder communication success. Visit 5QIR.com to learn more about 5Q's unique approach to delivering strategic IR and communications support. This podcast episode is brought to you by Canada Action. Canada Action strongly believes that as long as the world needs oil and natural gas, it should be supplied by Canada, where the economic benefits support our Canadian families and social programs. Canada Action believes it's time to champion our energy sector to help build Canada up and get our national economy back on track. Learn more at canadaaction.ca. This episode is brought to you by PipelineOnline.ca. Pipeline Online is Saskatchewan's energy news, providing comprehensive coverage on oil and gas, power production including coal, natural gas, geothermal, wind, solar, and nuclear. Pipeline Online now also provides coverage on emerging lithium and helium plays. No other publication matches the quality of Saskatchewan energy coverage. Find it all at PipelineOnline.ca. Good morning, Mr. Dave Burton. Thank you very much for doing this. I really appreciate your time. I know it's valuable, but there's a lot of people out there that will appreciate your insights.
Thank you.
For the listener, you're the CEO of Lycos Energy, but what is Lycos Energy?
So Lycos Energy is a junior heavy oil producer right now, playing the Manville Formation and mainly in eastern Alberta and a bit of western Saskatchewan near Lloydminster. And we are drilling ostensibly almost all multilateral heavy oil wells. So similar to the Clearwater, but different formations and long open hole, bit of a game changer, I would say. And that's been our whole MO as a company thus far. So about 5,000 barrels a day. So a little public company.
If I'm correct, Lycos is Greek for a spider?
It is, yeah. The wolf spider.
Why did you name the company after a spider?
So actually, it kind of came, my 12-year-old kid, when I was looking for a name, he said, well, you're always talking about 8-leg wells, because that's what we've drilled a lot of, and we've drilled 38-leg wells now as well. But he said, why not name it after a spider? And the wolf spider was a predatory, interesting-looking spider. So, and Lycos fit. Yeah.
The analogy of the wells, kind of the arms on the spider, I guess, too, the legs.
Absolutely. Yep. Yeah, the multi-legs. So it worked out well. It's part of our logo now, made for a fitting, good logo.
Engineer by training.
Very much so. Yeah. Yeah. Had not originally planned to be an engineer, but originally I was going to go into medicine. Most of my family was in medicine. My dad was a doctor in the forces. And I took engineering as if I don't get into med school, I can do this, and ended up really liking it. It's Bachelor of Petroleum Engineering and a Master's in Chemical Engineering.
Did you always want to be an entrepreneur?
I did. Yeah, I did. It always intrigued me. And I am not scared of the risk side of it. Certainly on the financial side, putting up my own money and all that kind of thing. I've always liked to run my own book. I felt like that was the least risky way to live. So yeah, very much so.
And then you got into the energy business. How did you get into energy and why?
Originally, when I went into engineering, I was going to do biotechnology because that was sort of that slant. I was interested in medicine, going to do all that. I had an advisor at University of Alberta that basically said, did you know petroleum engineers make the highest salaries of any engineer out there? I did not know that. And as a 19-year-old kid, that was very intriguing to me. So I did the petroleum route, and kind of the rest was history.
Got to pay the bills.
Absolutely. Yes.
Why did you start Lycos Energy?
Yeah, good question. We had a little private company. So going back a long way back with some folks that I'd worked with through a bunch of different companies. And then that same group of guys ended up doing headwater exploration. And they drilled a number of multilateral wells up in the Clearwater, just knocking it out of the park. Amazingly good wells, great company. I had a little company called Chronos Resources, private company, capitalized in 2014, right before prices fell. Basically, we were looking around for something to do and bought some heavy oil assets to try this same multilateral technology or process, I guess, in the Mannville. It started working amazingly well. And we thought we need more property, more inventory, and to do that, more capital. So we'll public it.
Maybe to go back in time a little bit, you have had a series of small companies that you've co-founded and had success with, but to go all the way back in time before Lycos, you had Wildstream Exploration, Raging River, Chronos, but you began your career at Remington Energy?
The first company I started out was a company called Mark Resources that ultimately became part of Enerplus. So I was there for a fairly short period of time, and then went to a company called Numac Energy. Scott Saxberg was there. A number of people were there. A really good company. We played Northeast BC Gas and a bunch of kind of Eastern Alberta stuff. And then from there, I went on to kind of the smaller companies. So did a few little small companies, but ultimately ended up at Remington Energy. And that's where I worked with Neil Roselle, who was, the main guy behind, obviously, Wildstream and Raging. So we kind of reconnected many years later after Remington sold. So Remington was an amazing company. It was a lot of very young, very sort of hungry, entrepreneurial type of people. And probably most of the names of the people there you'd recognize.
What year was that?
That would have been 1999, I believe. 98 or 99. Yeah. Long time ago. That's why nobody's ever heard of it. I bring it up in investment meetings and people are like, no, I've never heard of Remington. I'm like, oh, yeah, it's 25 years old now.
But there was something special going on there because you, Mr. Neil Roselle, and a bunch of other people were?
Yeah. Bruce Bonham was there, Steve Sugianto, Monty Bowers, a number of very, people have gone on to do a lot of things in the junior to mid-cap to even larger space after the fact. There's a lot of very smart, good engineers. It was a very entrepreneurial run business. Paul Bay was running the business at the time. He's gone on to do a number of other companies as well. So it was a very good mix of people. Neil, obviously, that was pretty pivotal in my career because he's a little bit, not much older, but a little bit older than me but definitely kind of showed me the ropes when I got there. And he's just a hell of a good business person. So I've leaned on him a lot and he's been super helpful in my career.
How did you all end up there and what was special about that company that led to so many successful entrepreneurs?
It's a good question. So they had a discovery up in Northeast BC at a field called West Stoddard, and it was an oil pool. It was a very strange oil pool, very light oil, very sour gas. So you got it was a small company that grew into something fairly big for where it came from. And certainly the equity side grew a lot. So everybody was interested in investing in it and making 10 times their money and all the rest of it. Didn't end all that well. Kind of, the equity went down again and, I lost a little money there. I think a few of the other people did, but the grouping of people, kind of everyone went on from there to do different things. I think you just had the right mix. And it's happened in Calgary a few times. Renaissance was like that. Merlin a long time ago was like that. So you had a number of companies where you just get this group of like-minded people together. They spread out a little bit, go on to do different things. But I think that sort of main attitude always sticks.
Who is the CEO?
At Remington? Yeah. His name is Paul Bay. So he's done a number of different companies after. He did True, at the top of my head, I can't remember the company right now. He's got one in South America right now.
But he hired all you guys.
They did. Yeah, very much so.
And then after Remington, like I mentioned, you had a bunch of successful companies. Where did you go from Remington?
Mainly successful, yeah. So I was working with a group, it was Avenir Diversified Income Trust, and then we had a number of kind of little spin-off companies. So some of the companies that came out of there would have been, one was ultimately Hammerhead Resources, one was at the Basque Oil Sands, all came out of kind of the same group of people. And so I wouldn't say I was necessarily a founder there for sure, but that was kind of, some of the stuff we were looking at. I had a company called Mahalo Energy, which was a coal bed methane company in Oklahoma, which ultimately ended up not doing very well. It's probably one of the biggest lessons I learned in my career. When I joined up there, I thought it was going to be nothing but money. Gas prices crashed. And ultimately I ended up getting hired to restructure that company through bankruptcy in the US. So I did learn that not everything works. And that was probably one of the best lessons I ever learned.
All the companies you've been with so far, does one stick out financially in terms of the returns that you generated for investors?
Oh yeah, Wildstream and Raging River for sure. They were just exceptional. I think that's a credit to Neil's understanding of a business and the capital markets both, but certainly on the core business side. Neil spent a lot more time basically putting together a really good, solid business rather than trying to play the stock market, if you want to look at it that way. So, and that's a big learning from him. Looking forward a long way. It's one of Neil's key traits, or I guess, one of the things he does management wise that a lot of people don't do is the details are important, and looking ahead a long, long way is important, not just next quarter. So both those companies did exceptionally well financially. Yeah.
When you met Mr. Neil Rosell in your, I guess it would have been your 20s or 30s, did you realize this engineer may be a little sharper than your average Joe?
In about 2 days. Yeah, you can tell. I mean, I know you've met Neil, but you can see right away he's a calm, collected individual, but he's got a really, really analytical mind and a hell of a good memory too, which is helpful.
What motivated you to step out on your own from, if I'm correct, you were co-founder of Wildstream, Raging River, and the various companies before, but what motivated you to step out on your own as CEO, as Lycos nowadays?
Yeah, you know what? A big part of it's kind of the creativity aspect. So I've always been involved in the sort of unconventional part of the resource sector. So I did a hydrogen sulfide miscible flood in northeastern BC. I did a bunch of enhanced coal bed methane stuff. That intriguing part of actually applying that reservoir engineering knowledge to what you're doing out in the field versus doing just what everyone else had done before. So I think with Raging River, we got to the point, we took a concept in the Viking that was sort of a good concept, but it was costing too much and just really drove those capital costs down. And it became a manufacturing process. Wildstream was very similar. We were looking at the Chronos formation. It was pinpoint fracs at the time there. And again, took a technology or a process that was sort of boutique and quite expensive and just really, really drove the efficiencies through it to make it repeatable in a manufacturing process. And I think with Raging River, it got to the point that it wasn't on autopilot by any stretch, but our operations folks had it down so well that, we were drilling more wells than anyone, probably as cheap as anyone else was. And I wanted to do something different. And Chronos was that vehicle. So started that up. Was going to do some Cantar fracking in Saskatchewan, but the floor fell right out of the oil price. And we went from $100 to 25 in a matter of months. So we just kind of sat and looked at it, and the balance sheet was clean, so that was fine. Another thing that I learned before, obviously, to keep a very low debt profile, because no matter what happens to prices, nobody can take your company away. So just kind of was watching that and what was the next best thing, and saw Spur go through the roof doing what they were doing, saw Headwater. Obviously the Clearwater, the barrier to entry was way too high for us, for a small company. The land was bought, the core stuff anyway, but looked as a reservoir engineer and went, okay, if you take the same process, so they've got pretty good rock and decent oil, heavier oil, but still decent oil. And if we looked at pretty good rock in the Manville, but pretty crappy oil. I mean, it's heavy, it's peanut butter, right? So looking at that, can you make that into what they were doing? And the way to do it is just drill longer wells. So that's what we went out and did. So Lycos, when we were private, or Chronos, sorry, when we were private, we drilled a 15,000 meter well, so about 50% longer than what they were doing in the Clearwater, and got a really good result. And I think, that's when I was kind of talking to Neil and Kevin Olson, who's the chairman of the board, a number of other folks saying, hey, there's something here. I don't know if it's a private company or a public company, but the barrier to entry in the Manville is quite low. And if we can make these kind of returns, they're not Clearwater returns, but they're still triple digits. I mean, you can make money doing this. So that's what we set out to do. And that's really, I ran it kind of because I had to and kind of because I got it. I was here and, I had a lot of my team that's here right now was with us at Wildstream and at Raging River as well. So on the operational side, so they were going to do their part to drive these costs down like we have. I figured I might as well give it a shot, take a swing.
Through the 90s and 2000s, we worked with a lot of successful people and had success at Raging River and Wildstream and kind of had the blueprint, but then things started to change in 2014, 2015. How did you think about the risk of starting a junior energy company in times like now when maybe things have changed in the junior energy market. How have you thought about that?
Yeah, I think, even when we started Lycos really in earnest, so originally we'd kind of talked about doing a small pool of capital just, internally from people I know around town and doing it that way, because that would have been kind of late 2021 and things were still pretty dire. Federal regulatory wise, obviously the oil and gas industry has been somewhat targeted for 10 years. So that was where I saw a lot of the risk was. The other thing was there was no capital available anywhere. It's just institutional capital had all but dried up. And there was a flight of capital out of the industry, obviously, as well. So it was either going to be like our own money or some smaller pools of capital, family offices, things like that. So originally we just sort of talked to a few people around town here and a few people in Toronto about, hey, would you be interested? This is a cool technology. It's kind of extension of the Clearwater, brand new company. And sort of through all that investigation, figured out that there may be a public vehicle here. And when we went to market, the IPO was received incredibly well, substantially better than what I had thought. So, which was excellent. Part of that was it was the first sort of growth company to come along in a while with maybe a little bit of a different take on how to do things versus just we're gonna do what everyone else is doing. To the question about risk doing it, the risk on the technological side's always been the same. The risk on the access to capital seemed insurmountable when we first started looking at it, but ended up being okay.
For the layman listener out there, the idea/strategy behind Lycos is to apply new drilling technology to old plays, aka targeting old oil-weighted assets that are unexplored, unexploited, undercapitalized, and offer opportunities for growth.
Absolutely, yeah. It's, so what we were really looking at, I drilled when I was at Newmac, I drilled hundreds of traditional heavy oil wells, what we'd call chops wells at the time. And they were vertical wells. Actually, most of them were on a 45-degree slant. And you'd produce a ton of sand. Like 30% of your production stream would be sand. So you're basically creating your own permeability in the rock, which was great, but it was expensive because you had to deal with the sand. And ultimately, a lot of those wells could collapse because you were creating this big void in the ground kind of thing, right? When you're producing all that sand. So kind of looked at that and thought, well, the math is completely different when you look at it from a purely engineering point of view in the multilateral wells. That's why the Clearwater worked so well. So yeah, we were looking at saying, okay, we're going to take a kind of a C+ quality play and turn it into a B+ or an A quality play with brute force, basically drilling much, much longer wells. The key to that was this fishbone design that we were using originally was how do you make a longer well when you're very shallow? And physics interferes with it because if you're shallow, you don't have a lot of weight to push out a long way. So basically we created a different design. Rather than drilling an 8-leg well, we drilled a 38-leg well, which you hadn't seen a lot of those around and you hadn't seen any fish bones to the length of what we were drilling. So it was a bit of a different design. Took a lot of engineering design work in-house here to figure out how to do it without spending a ton of money. But it's applying that kind of fit for purpose well design to overlooked heavy oil plays. If there's something available out there right now, people have looked at it. We've got a lot of really top-notch technical people in this town. It's been looked at and dismissed. So we're looking at that stuff that's been dismissed and saying, hey, can we apply something different, like the fishbone well, to exploit this and make money at it?
Maybe for the listener again, what is a multilateral oil well and how is the fishbone drilling technique different from that?
For sure. So a multilateral heavy oil well, for the most part, would just be an extension of the horizontal well. So originally I had vertical wells straight up and down. And then a very smart engineer out there somewhere said, hey, what if we just go around the bend and drill sideways all the way along through the reservoir and get a lot more contact. So it's all about contact to that rock. In a vertical well, you have your 6-inch or 5-inch well bore and that's it. And you turn it sideways, you can suddenly extend that out to 1,000, 2,000 meters and you get much better wells. And that was kind of the revolution of the 80s and 90s was the horizontal well. Unfortunately, on a lot of the heavy oil wells, and this is straight on the math, you don't have enough reservoir contact to make an economic well with 1,000 or 2,000 meters. And again, some very smart engineers out there said, well, what if we drill more than one horizontal leg from one well? And it was two originally. They had the wishbones and then there was the quadzillas and there's all these great names for them, right? But so basically it's open hole. So you don't have any kind of pipe or anything lining these wells. You're just drilling an open hole well, but you're doing 4, 5, 6, or 8 of these legs that all converge into one well bore and then come up out of the ground. So you're getting that more length. And you go right back to the math and it's all about length or reservoir contact drives your flow rate. So the more of that you can get, the better. The problem with going more than 8 legs is you start getting into problems with metal. And I mean, you're trying to bend around too far when you think about it. And as I say, you can't drill straight ahead that far because you're too shallow to do that. So the fishbone was just a clever geometrical way of saying we can only go out 1,500 meters. So we're going to drill one well, and then we're going to kick off that well 38 or 40 times with all these little ribs, like a fish skeleton, right? That's why we called it the fishbone. So, and it's worked incredibly well. We're at the point now we're doing sort of hybrids between those. And it's really just getting creative with trying to get that length in the reservoir with the physical constraints that you have.
This podcast episode is sponsored by Conate Water Solutions. Do you need cost-effective water sourcing options to supply your next drilling or completions program? Conate Water Solutions is a specialized hydrogeology company focused on water well drilling, testing, and water management services in Western Canada and Texas. Contact info@conatewater.com or check out conatewater.com for more details. Sometimes drilling multilateral wells and new technology is expensive. How does Lycos balance that portion of the business with generating actual profits?
Absolutely. That's a great question. When we first did our fishbone well, it was an aggressive well considering it hadn't been done before. So we were drilling a 15,000 meter well with 38 legs. And the thing to think about there is each time you start a new leg, so we call it a sidetrack, and you're initiating that new leg from the leg you're in before, that period of time originally was 5 or 6 hours to start that leg. So when you're trying to do 40 of them, suddenly you've got sort of 10 or 11 days of just wasted time. So our operations people, so Kyle Boone, our chief operating officer, has been with us a long time, and he was with us at Raging and Wildstream as well. And he kind of set out to work going, how can we take that time and minimize it? And every now and again, you'd get a sidetrack that was sort of 30, 40 minutes. Well, let's study what's going on there and see if we can replicate it. So our average sidetrack time now is between 30 and 40 minutes. It's a huge reduction, and that's what allowed us to drill that well. The first one, the fishbone. The driver behind that was basically we were using our own, we're a private company. We didn't have enough money to drill a $5 million well. So it had to be $1.5 million or $1.7 million well is really what drove it. So we're extremely cost conscious here. Again, the whole MO behind the company is take this process and make an efficient manufacturing process to replicate that over and over again. Once you learn how to drill a fast sidetrack, don't forget on the next one. You know, that's really what it is. So obviously your economics can go away real fast if you double your well costs. So we have a lot of our own money in this company, like all the companies. And that's something, again, took away from Wildstream and Raging with Neil was have skin in the game. And almost all, if not all of our employees have an investment company as well.
You felt it was important to have your own money in the company to create a symmetry of risk with your shareholders.
Yes. I think that's the only way to have that right way risk. If you want to do what's right for your shareholder, you should be one. You've got to think like them. I think if you're not, it's probably too easy to take too much risk. It's like taking on a bunch of leverage, right? If it works, you're going to do really well. If it doesn't work and you don't have any money in the company, I guess too bad, so sad, unless you're a shareholder and then you've lost it all. So we have a large insider ownership. We're very much aligned with our shareholders.
There are other companies in Calgary and Canada targeting old oil plays with new technologies. What makes Lycos different, and how do you separate yourself from those other competitors?
Yeah, there's a lot of, I think Canada's always stood out as being good technologically. And I think I've worked in the US, and I think we're well known for it, for being creative, because we have to be. When you're trying to do funky things when it's minus 45 and windy, you got to do it a little bit differently. And, we've always kind of been that in the world. So there's lots of good companies doing this in Calgary for sure. I think what sets us apart a little bit is certainly first mover advantage in a way in the Mannville. So we like the fishbone style, especially the extra long well, the 15 to 20,000 meter wells. Like we have almost 500,000 meters of open hole drilling as a company since we started at the end of 2022. So in a little over a year and a half, we've drilled, 500,000 meters of open hole heavy oil. So we do have the experience, and we learned a lot through it, very much so. So that's part of it. I think the other part is in how we're looking at things. So we'll come across some land that has obvious problems. Topographical problems, it's close to a river, so you got to move away. Whatever the case may be, there's a reason it's still there. We sit back and say, okay, is there a way to develop this economically or not? And when we see that there isn't, we look at it again. And if we can't find it, that's great. But usually we've found a way between our geologists and our engineers to develop it appropriately and really exploit that resource. So I think that sets us apart a little bit. Now, that being said, if you take a company like Spur or Headwater, they're going out to a play that we've known about for 50 years, the Clearwater, but it's only been the last 10 that it's become probably the most economic play we've ever seen in Western Canada. So, we have that model to go after to say, when you want to give up, don't have another look and see if there's a way to do this. So I think that sets us apart a little bit, is that creativity aspect, which as engineers, for the most part, we lack creativity almost exclusively. But you need a dash of that in there to really look and say, maybe this was overlooked for a reason, but maybe with the way we're looking at it. And a really good example, we've done some wells called the Wine Rack well. So we took two formations that were a little bit too thin to justify a well on their own. And we went, well, what if we stacked them together by putting one multi-leg in the bottom, followed by one on the top, followed by one on the bottom, followed by one on the top. And they've been incredible wells. Two of them were just some of the better heavy oil wells in Alberta for last month. So,
due to the fact that technology in the energy industry is proprietary at times, but widely shared, sometimes the advantage isn't in the technology, but in the intangibles like management. How important do you think the fact that you have good leadership is to the company, although you're a little biased?
Very biased. Yeah, I think that leadership, first of all, we're very hands-on. Every one of our executive is hands-on in the business. From the technical side, I was on a drilling call this morning. I am most days, as is Kyle. Lindsay, our CFO, is very hands-on in what she does. So we're very, very much in tune with the company. And I think not only does that allow us to understand the business the way we should, again, going back to the details, but I think for everyone else working in the company, they see that it's not an ivory tower concept. We do understand what they're going through in a day, both to the good and the bad. And when they need resources or help, even, for more staff, whatever the case may be, we can see it coming for the most part. So I think that's really important. I think the fact that everyone has a leash to really go out and say, what about trying it this way? Those healthy discussions. Big difference in an argument and a fight, right? And I think an argument is very healthy to say, I believe this, I don't. Well, let's hash it out until we both believe the same thing. So that's kind of the top-down structure that we have here. We're a pretty flat organization. We're not heavy on staffing. We've got 22 people in the office. But that, I think, has allowed us to exercise that creativity appropriately rather than people thinking it's just going to get shot down. And part of that is risk. If you come in and say, I'm suggesting a brand new well type, it may not go perfectly the first time. So you can't come in and yell and scream, which I'd never do anyway, but at someone for, a failure and a brand new concept, because some of them aren't going to work. But the ones that do, we replicate over and over again. We built a decent business from it.
Some companies are led in a kind of autocratic manner with a leader that likes to beat their chests and give orders to the staff. And sometimes it works, but when you look back on things, do you think a more team approach, collaborative, works in the end?
I'm a consensus builder kind of a person. I always have been. I guess the way I would look at things is, if I think I'm right and you're wrong and I can't convince you of that, then either you're really stubborn or I'm not doing a very good job of trying to convince you. And I've always believed that. And we've run that model here. Somebody being silent about something because they think they're going to, quote unquote, get in trouble. It just makes no sense. People need to be able to express their thoughts. They're the closest to things. If you take your manager of drilling, they're going to be the closest to the rig, much closer than we are. So you want that communication of what's happening out there. So the autocratic chest pounder will be the exact opposite of our leadership style here for sure.
Why did Lycos decide to go public instead of staying private with your own money?
Yeah, and I get that question probably 3 times a week. A number of the other sort of multilateral companies like Caltex out there is private. There's a bunch of companies that are, and it certainly makes sense. One of the reasons we decided to go public was we felt that with the city having almost no debt, most companies have a pretty solid balance sheet. They didn't always need cash. They're returning cash to their shareholders, right? So it was something different for growth. So one of the things we looked at was, well, if we have paper and it's liquid, it's an actual asset that you can go out and buy and sell, that may be of more value when we're trying to acquire new properties to, say, a larger company. Here's, a combination maybe of cash and some stock. But private stock's always been tricky because it's so illiquid and tough to pin a value on. So that was part of it. And I think access to the capital markets was part of it too, that we want to grow our inventory. We know what we're doing is working and we're getting incredible cash returns. We need to get more. So part of it was acquiring that with paper, and part of it was when the right deal comes along, you may only have 48 hours to go out and capitalize that deal, which requires the public markets. So do I regret the decision? Some days, sure, but not really. No, I think it's been the right way to go. It's a lot of work to manage the capital markets side of a public business, though, which nobody loves necessarily, but it's part of what you do and it's there for a reason. So I think I have a healthy respect for that. But it gives you access, I think, as well to some shareholders on the generalist side that you wouldn't otherwise see as a private company. I think that's helpful too. So
the critic would say, I want to invest in Lycos, but I don't see a runway in the public markets for a return when nobody's recognizing the value of these equities. What would your response be to that?
Yeah, I think, there's certainly some truth in that. And I think that's on the private side as well. I think there's really only a couple of strategies as you get big enough. One would be returning capital to shareholder in the form of a dividend of some kind. And the other would be to be acquired by someone else, most likely to do the same thing for them to provide inventory to return capital on investment. I think as long as we build a good business, it doesn't really matter if we're private or public. As an investor, I get it because you haven't seen a junior energy come along in a long time. One of the big questions we had, who are your comps? Well, there aren't very many, right? And the only companies that have gone public recently really have been ourselves, Logan, a few others, but there's not what we used to have, this sort of plethora of small companies, and you could mix and match and pick and choose. So I think you need to be patient, certainly for us, but as well as the investors, to say, okay, go out and do what you're doing because the math will take care of itself. When you're getting these kind of returns, the business is going to grow. We're growing double-digit returns just spending cash flow. And I think that's the important part. We have a lot of our projects, a lot of our wells have paid out in less than 5 or 6 months. So you're literally getting all your money back in the same calendar year you spent the capital. So that not only is that highly profitable, but it de-risks things massively. So I think there's just, keep posting good quarters and the market will follow. And there's always that sort of dead space before you start to pick up. And that's what I would say to them is be patient. As long as we do our job stewarding not only the capital, but the inventory to make sure there's room to keep doing what we're doing, then your valuation has to catch up.
Over the long term, genuine profits and cash flow will be reflected in the stock market, but sometimes the investors are scared that you're just one equity raise away from a dilution or one OPEC decision from erasing the margin. How do you convey that confidence to the market?
So that's a great question. Unfortunately, I've been in the oil business since 1995. Calgary has seen capital destruction like no other business in the past, right? And a lot of that comes down to, it's exploration. You take a swing, if you miss, big deal, whatever, right?
It's not intentional.
It's not, no, not at all. And when it hit huge. There's been a lot of wealth created in this city. There's no doubt about that.
Yes.
So that being said, I think the new model, though, now that equity for the most part is difficult to get, it's doable, but you have to have the right project. You don't just show up in, Toronto or New York with an open bag and they fill it with money and you come back to Calgary like it used to be. So you have to have a well thought through acquisition, whatever you're doing, with their plan for that capital that will show everybody it is accretive. That's step one for sure. I think the other part of that is on the pricing side that you mentioned. And we're exposed to two parts of that, not just the oil price, but the differential price, right? So we've got to manage both of those. Some of that's risk management, certainly on the differential side, and some of it's just planning properly on the leverage side to be able to weather those storms. So the fact that bank debt wasn't available and sort of isn't really now, certainly not to the quantum that it used to be, is probably helpful because it makes us build better businesses and more resilient businesses. So if OPEC makes a decision that's not helpful for us, it's going to be short term because ultimately their driver is profit as well, but you've got to be able to weather that storm. So keeping debt levels down substantially, I think, is the key to that, and not overextending yourself. That's the best way to do it. Cyclical business, the cycle's getting shorter probably, but you've got to make sure you're ready for anything. And going back to what we talked about, looking long term, we model the company out 20, 30 years to make sure you know exactly what's going to happen. Do we have inventory to drill 30 years? We don't right now. And of course, you grow that as you go and find new things and so on. But you need to know where the business is going at all times to make sure you're resilient.
One of the other ways seasoned professionals in the sector would suggest you run your companies with low costs. Lycos has, I think, about 20 people in the head office here. Yep. How do you keep costs low?
So there's two parts to that. There's your field operating expenses, obviously, that come directly off the bottom line. And then there's general administrative costs, and I can address them both separately. We're a heavy oil company, so the field lifting costs, production costs would be on the higher side of a conventional play. A really good conventional play, you can be $10 or $11 a barrel. Heavy oil, because you can't really pipeline it, you're in that $16 to $20 a barrel. And you do everything you can to keep it there, or it will get away on you. So we focus very heavily on that. But we do have to acknowledge the fact that you're trucking a lot of this oil until it gets to a point that you can put the diluent in and send it, to wherever you're going to market it. So there is that side, and we focus fairly heavily on that. The offset to that on the field cost, though, is we do everything we can to get an extra dime, quarter, whatever it is on the price side. So on the marketing side, there's a lot of little things you can do. If you can't take a buck off the OpEx, can we add it on the price side? And we've been very successful at doing that part. I think that's missed in the city a lot. There's some very good marketing minds here, but we focus so heavily on the field activities themselves, you forget that $1 on price is the same as $1 deduct on OpEx. So we do a lot of that. The general administrative costs, we've been exceptionally fortunate at who we can hire on the technical side. People want to be part of something small and exciting. It's fun. It keeps you going. So we have tremendous technical people. On the sort of accounting administrative side, the problem is you're competing with everybody. I mean, a petroleum engineer is going to work for an oil company. If you're doing accounts payable, you can work for an oil company or a bank or the university or, the federal government, whatever you want to do. So costs there have certainly gone up. And the way we manage that is just trying to do more with less people and just be efficient. That's all you can really do.
There are new software programs being created and apps and advancements in that side of the sector. Do you view technology as a way to help with costs? Are you exploring options in that
we absolutely do, yeah. And I mean, those tools, the ones that stick, the ones that not only are they a good idea, but people adopt them and really use them, are game changers. You look at something like an AccuMap as an example versus 40 years ago when people were pulling data by hand. It's a complete game changer. You have one person, like a geologist right now, can do a cross section in a minute and a half. And that used to be a technologist or a permanent technician's job for, a day and a half to splice those together. So yeah, it's a huge change in the output that we're able to put out. And obviously there's a lot of AI based things coming out now, some of which will be pure snake oil and some of which will be very helpful. And we'll have to see what works and what doesn't, and what gets adopted and what doesn't. But yeah, I mean, that's a huge part of what we do, is to try and limit, keep the work to the value add versus I have to do this when it could be done by a computer or whatever the case may be.
From the perspective of an energy producer, how do you think about testing new software programs? Do you just suggest they come in and run a test or simulation on your data set and see where the revenue saving or the cost savings are? How do you approach that without spending too much money?
It's a good question, because, a lot of times you might look at something and say, we don't need that, but you might not know what you need. And that's, so to your point, yeah, a lot of times what we like to do is have a software provider come in and just pitch, how will this help us? And the ones that can say, you don't know you need this, but if you had it, this is what it would do. And you go, you're absolutely right. And then it's worth the cost, because you're always looking at the cost of software. It's just coming off the bottom line. So if nobody needs it, or if you're adding a layer for no reason, but the successfully adopted software packages are game changers in our industry. From field data capture systems to, completion information, something like Payzon, let's say, for watching drilling live, where, you can sit on your phone and, your backyard and see what's going on with the rig in the middle of the night. You probably shouldn't be in your backyard in the middle of the night, but if you chose to, you can see what's happening on the rig. So they're game changers. And I think there's times where you really have to fight that urge to kind of dig in your heels and say, we didn't do it like this before and it worked. Why would we do it that way now? Some of the programs are useless. There's things out there that seemed like good ideas and aren't, but there's a lot of times that you just don't see it until they show it to you. So we're open-minded.
If I'm correct, the debt to cash flow of Lycos is approximately 0.3 times.
That's right.
You've already mentioned that it's an important part of your strategy,
Extremely.
But how important is it to just keep low debt?
Yeah. I mean, I think, again, look, it's obviously tempting. And when you go south of the border into the States, you see substantially higher leverage ratios than you see up here. And I can see why. Obviously, that's the best way to make money, right? Is to borrow money and use that, use leverage to your advantage and returns. That being said, we saw it happen in the mid 2014 to kind of 2019. And then through COVID, we really saw it happen with bank lines being pulled and all that kind of stuff. You can't go down because of debt if you don't have a lot of it. So at 0.3 times, if we stop drilling for a quarter or a little more, maybe, our debt's gone. And that's really the way we look at it. It's a short-term tool. We took a little bit of debt on the balance sheet for some of our acquisitions. It just made sense, but it's de minimis and would always keep it that way. You know, a 3 times, 4 times debt to cash flow ratio like you'd see in the US, I just don't think it functions in Canada. You don't have the backstop on the lending side to do it, and it puts you in peril, you know. And again, going back to your point about skin in the game as investors, an overly leveraged company, if I didn't own any shares in it, seems like a great idea.
Yeah.
But not, you know, and for the shareholders, I just don't think it makes sense to risk their investment by levering your returns. If you need debt to make your returns, then chances are it's probably not a great project. That's the way we'd look at it.
From the perspective of M&A, sometimes you need debt to get a deal across the table. How do you balance that aspect of the business of refilling the hopper? Maybe you don't need to because of the organic drilling, but how do you think about M&A? You're trying to pay with just cash, or how do you approach deals?
Well, again, I mean, one of the reasons we went public was that you can use your paper as a currency to buy things. So that's certainly part of it. We would structure the financing of a deal to the deal itself. So yes, you could certainly put some debt on the right deal. You know, if it's a highly, highly accretive deal and that's going to, you know, be what it takes to do it, that makes sense. But we can't jeopardize what we already have to go out and buy the next shiny new toy with a bunch of debt. So I think, again, I would never say never to anything, you know, to push over 0.5 times. And that's kind of our hard ceiling right now. But there would have to be a path to reducing it back down to that comfortable level very quickly. I think if you've got a good enough asset that you're buying, equity shouldn't be a problem and it should be accretive. Again, going out to the markets, they're going to look and say, no, you're not diluting us down, because I don't want to dilute myself down either, obviously, right? M&A is something we look at a lot, probably heavier on the buying inventory land side than we are on the producing reserve side, because I think we can convert it more efficiently than what we have to pay to buy it. But it's a big part of what we do. Most of the things we've bought so far, no one's ever heard of, and that is by design. We don't want to have a lot of competition in something, so the way to do that is to go after something nobody else is going after.
There are a lot of eyes in the market.
There are. And so, you know, when you go into a marketed process, there's a lot of great assets that have gone through marketed process with the various dealers in town. The problem is they will eke out all the value there is. And that makes sense for the seller. We would rather go at something with the proposition of, hey, we can do something different than what you can do. And part of the way we're going to pay for it is with our paper. And when it works, our paper goes up, and therefore so does your investment.
If I'm correct, you are the top insider of Lycos Energy?
That's correct, yes.
Where do you see the company going the next few years to create value for yourself? Is it just through generating profits and an increased stock price over the years, or is it through selling maybe? Or how?
Well, it could be. Yeah. Again, I think there's, you know, as much as I would like to say there's 15 or 20 different strategies to monetize value for a shareholder, there's really only 2. Growth is growth, and we're going to continue our growth pattern for as long as we can, because that obviously builds your base out. If you're going to return capital, the more of a base you have, the more you can return. It's obviously highly profitable that way. But there's a point in time where either you own everything or you've got to back off on it. You can't grow 50% a year forever, is basically what I'm saying. So I think when you get up, you know, a couple of years from now through, say, 10,000 barrels a day, you're a big enough company that you've got to take a step back and look and say, okay, is now the time to use that free cash flow, back off on the drilling a little bit on your growth profile and start returning capital? Or again, do you look at the other companies that are out there doing that and say, hey, we've got this prepackaged X hundred wells of inventory that maybe you want to develop, and, you know, we'll sell it. And then we would do the same thing again, quite frankly, of a new company. I mean, I love that phase of it. Obviously, that's my own personal bias, the startup. But there's times when it's not the right business decision. It would be better to continue on with what you're doing, drill up your inventory, and return capital to the investors. So that's where I see a couple of years from now is us having to make that decision of, what are you going to do with that free cash flow? We spent all this time generating something to make it. Do we pay it out to the investors? Does somebody else do it? And I'm kind of agnostic to it, quite frankly.
The nice thing about oil and gas organic drilling is, as an early investor, you put $1 in and maybe in 10 years it's worth 10.
Yeah.
But when you go to sell the company and you present to the market, at that time they know you want to sell. How do you get the value out of the company that you want when people know that you want to sell? Is it because early investors put their money in at $1?
Yeah, you know what? I mean, as far as the market goes, I think when you get to that inflection point of saying, hey, we can't grow at 40% anymore, we're going to grow at 8 or 9, then we can look at what that sum of free cash flow is for the next X number of years, discounted, obviously, time value of money basis. Or somebody else can come in and accurately reflect what that inventory means. And you've obviously got to trust if you're selling for cash, well, that's cash, that's fine. But if you're selling for either paper or a combination therein, you've got to trust what they're doing as well. So I think it kind of comes down to that scenario at the time. Why you would make the decision to sell, I think would be just as an alternative to becoming a return on capital company would be the deal. So it wouldn't be we have to sell or we really want to. It would be, what's the value proposition look like of returning the capital ourselves or having it be part of a bigger entity?
And for the layman, when you invest $1 at the beginning and the end of year 10, it may be worth $10. So if somebody offers you $8, the investors are still winning at the end of the day.
Yeah. I mean, obviously we're trying to structure the company so that all the investors win. We've only done 2 equity raises right now. But yeah, I think it's one of those things that you don't want to give up what you could have had just to have somebody else do it for you. So I think there has to be a synergy with their business. That could be on the cost side. If you go into a larger company, maybe they have access to transportation that we don't have, or, whatever the case may be. Maybe it de-risks things. I don't know. But yeah, there has to be a value proposition there that you're going to get more selling than you would reaping that cash flow yourselves, because we're certainly not afraid to do that. It's a good model.
What worries you in terms of Lycos?
Everything. Honestly, because, it's like anything else where you've made a promise to your employees. I've made a promise to my family. We've made promises to all our shareholders, and they're meaningful to me. I mean, that is something you're putting your word out there to say, I'm not going to say we're never going to make any mistakes, but we're going to do our damnedest not to. And if we do, a regulatory change, as you say, an OPEC decision, I have no control over that. Sometimes price goes down. There's nothing you can do about it. But I think you have to make damn sure that you've done everything you can to protect everyone's capital, because it's, as I say, it's a handshake and it's a very meaningful one. You've taken someone's money and they could have put it anywhere, and they're trusting you as a steward of their capital. And that's extremely important from an integrity point of view and from a reputational point of view, but just from a personal point of view. Yeah, you lose a lot of sleep worrying about how things are going to work.
Does Lycos hedge much of production?
Short term, we do. And again, I think it's something that's quite important out there that maybe some smaller companies don't spend a lot of time on, is that marketing aspect of things. We watch it very closely. We've done a fair bit of risk management on the differential side. If you overhedge on the commodity, people are going to say, hey, I'm playing oil and gas for the exposure to the commodity. You got rid of that, of that volatility. So now I don't want to be there. I don't think anybody's playing our company for the risk on the differential, the volatility. That's just a straight deduction. So if we can get our heads around something that's saying, hey, next year's minus $14 right now, that seems like a pretty good number, in that if it gets better than that, it's by $1 or $2. But if it gets worse, it could be by 20. There's that asymmetric risk profile that we're always looking at, going, okay, let's protect ourselves there and make sure we're not in an environment where oil prices are great, but differentials are massive. And we've seen it so many times in heavy oil. It's just something you got to play. So we spend a lot of time on that. We'll do some shorter term commodity hedging as well, just to protect a capital program or whatever the case may be. There are times when you can look at a price and just say, hey, that's good enough. You see the $100 hedges next month, not right now, but in the past. So yeah, we're not going to cry over that. If prices go way up, we can always drill more. We have a lot of inventory right now. So you're long the commodity naturally. Some hedging, some risk management absolutely makes sense to us for sure.
Will new pipelines help the differentials in Canada?
Yes, absolutely they will. Right now, I would say we're probably serviced from an egress point of view the best we've been in decades with TMX coming on. We don't ship anything down TMX ourselves because everything we have goes east or south in the States on Enbridge, but it has taken a ridiculous amount of pressure, volume pressure off the lines we go down. So things like apportionment that can be killers, where there's not enough space and suddenly you're getting a discount, and that's kind of gone away for right now. So I think it's really helpful. Opening up a new market other than just the US or through the US has been incredibly helpful. When you look at the differentials now, it's not just where they are, like the discount right now is going to be minus 12 to minus 15 kind of thing. And I see that in the future as well. But the volatility before, if something happened in the US, you went from minus 10 to minus 40. And those are tough to swallow. And that goes back to the leverage comment as well. Things can change very quickly in the short term. So, but I think this smooths that curve out, having that pipeline. I think we need more. Obviously, we need more export capacity in Canada. Whether we'll see that or not, that's a federal government thing. So hopefully, I think it benefits us immensely.
If and when the natural gas egress problem gets solved, How do you see that impacting Lycos? Do you have natural gas exposure, or are you
Not
focused
much.
on
Very, 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 very little. The only way that, and it's kind of a strange thing, the only way that natural gas production really affects us is a lot of wet gas drilling, the liquids. Yeah. And you can flood that market with liquids, which should help on the price of the diluent we buy. Problem is some of those liquids are quite heavy. They're not really a condensate. They're almost an oil, which means we have to use more of it to dilute down to the viscosity that we need to ship our oil. So it can be bittersweet depending on what's happening on the liquid side, but that's really the only exposure we have on the gas side.
What do you think the catalyst is for energy equities to be valued at a higher multiple in the markets?
Wow, it's a great question. I think there's a number of things. I think that the sector, since I've been involved in it and I've been involved in raising capital for a long time, you used to walk into an office in Bay Street or in Wall Street, wherever, and the person you were talking to on the PM side, you'd swear they were a geologist and engineer. I mean, they knew everything. They were highly educated in the sector. For the most part, now the people you're dealing with are more generalists. So they're watching more macro things. So there's some of the nuances being missed. You know, I had somebody ask me when we first started the company, how long is it going to take for Calgary to rebuild that infrastructure of technical people and, you know, to get the machine going again? That's not the right question. How long is it going to take to do that here in Toronto on Bay Street, to have the people that really understand the difference between each company? And so less volatility on pricing for sure is going to help. So people can plan ahead, forward, more results from newer entrants into the sector. Like I think right now the undervaluation is crazy. Even companies that are deemed to have high multiples are cheap. They're not cheap in the context of the sector, but they're cheap. You know, trading a company with 25 or 30 years of life at 2 or 3 times cash flow makes no sense. And I think people know that, but it's going to take time for people to move back in. And I think once, you know, the federal government boot is off our collective throat as an industry, that would be helpful as well.
Might be coming soon.
I'm hoping so. Yeah. The by-election yesterday is probably a good sign of things to come from that side of things. So
from a capital allocation perspective, when the shares of Lycos are undervalued, do you think about deploying your capital just in the public markets to de-risk your capital allocation? How do you think about that?
So we've had that question a lot about an NCIB of some kind to buy back shares. And it certainly makes sense for all companies. For us, the management of it at this point, if we're incredibly undervalued, then yes, for sure. I mean, that just makes sense because that would be the highest return on your capital. The problem that I have right now is when we're paying out wells in 3 or 4 months, when you're getting triple digit IRRs on a lot of the wells, you're doing twofold. One, you're growing your base and you're growing your understanding of your inventory and de-risking inventory by doing that for future development. And then I think the other thing is I don't think we can match those returns in the capital market. And, you know, I'm a driller, not a trader. So I think as you get larger, it's something you absolutely have to look at. But then again, do you buy back your shares or do you give the cash back to the investor or both? I think they're both great strategies. For a company our size, I think it would be underused and probably difficult to manage. And I think our eye needs to be on what we do best right now, which is, you know, expanding our inventory and drilling multilateral heavy oil wells.
Advice to a young entrepreneur or a young person starting a business, what would you tell them?
It's a good one. I think that the biggest thing outside of really, really understanding everything and knowing the business and understanding the details, because an engineer don't just understand the engineering part, learn the business. You know, as engineers, we can be terrible understanding basic financial statements. Everybody should take an accounting course in engineering school, I think. Everybody should take a law course in engineering school as well, but also understand you don't have to be a geologist. You don't have to be an accountant. You don't have to, really understand all aspects of that business. So you can understand what they're doing, but also how to staff, how to provide resources, and understand your own risk tolerance. I think you see a lot of people going into entrepreneurial ventures that if they lost the money they put in, it would be soul crushing. And you can't do that. I mean, it's never bet what you can't afford to bet. If you go to the craps table and you want to put down $10, make sure you can lose the $10 because it can and will happen at times. So it's sexy and enticing to run your own company and be part of something like that and grow everything, but it's not a guarantee. Otherwise, everybody would be doing it. So I think personally, I'm okay with that, as I said at the beginning, but not everybody is. And I think those people do not belong in the entrepreneurial market and should be part of something different. So it's like anything else. Self-realization, knowing yourself and what you really are versus what you want is incredibly important.
And a quick shout out to Ryan Smith at Comat Drilling for connecting us.
Excellent.
Thanks,
yes.
Ryan.
Thank you, Ryan.
That's it.
Superb. Thanks very much.
Thank you very much. I really appreciate your time. Hello, listeners out there. Thanks for checking out the podcast. Hopefully the episode provided some insights. If you enjoyed the show, check out trose.ca where more episodes are yet to come. You can also subscribe to the podcast where your token of support is much appreciated. Until next time, happy coffee drinking.